Happy Friday, Pat.
Hey, buddy, how you doing?
I don't even remember Monday through Thursday.
I swear to God, I know. Just once again, as you get older, it's just amazing how time flies.
Yeah.
We're
I
in the
don't know
middle
if
of
it's
October already.
age or just incompetence.
It's probably both.
Oh, shoot. Well, it has been an interesting week. I'll remind everybody that we have a show sponsor again, Red Hog Media, and they do vacation rentals and long-term rentals. So whatever your photography needs are, they also do headshots for any realtors out there that are looking for that. Or if you're just looking for a neat photography session for your family, Red Hog Media is the one. Go to their site. It's in the link in the body of this show and punch in the discount code Rick Helps and get 10% off. So anyway, interesting developments. Nothing really radical this week, but we always know that November and December are going to be slower, right?
Yeah,
And,
yeah.
It's starting already. If you look at this, we're down to, on the 7-day moving average, 2,200 homes. That's unbelievable. 2,264. But you can see that the new listings now are really starting to taper off. We still have this huge gap, but the new listings are tapering off, and that is only going to get worse as we get into the holiday season. So it's going to be, we know that sales are going to be slow, and we can see that. Sean, hey Sean, yeah, I'll do that in about 2 minutes. I'll give you the 2-minute warning here.
Huh? What was that? I took my earpiece out.
He wants to know if I'll discuss politics. Just, I could have gone on there and just said, okay, we got 2 gubernatorial candidates that are going to do something about water. Here's their link. And that's all I should have said. But anyway, I got beat up pretty bad this week. So I don't care.
Yeah.
The 2 big developments in the real estate market right now are Paradise Valley and Fountain Hills have come down. The change is 18%, 10%. They've been kind of riding this wave in the luxury market, but this is a direct result of the performance of the stock market. So the 2 luxury markets now are starting to feel a bit of a pinch.
Now, correct me if I'm wrong. Go back to that chart. I mean, those numbers, those current market indexes those are the ones that were in the 200, 300, 400 range.
Paradise Valley and Fountain Hills.
I mean, back in when it was hot, the 159, the 90s. Didn't we see numbers in the 200, 300 range? Is that right?
Nope. Saw them in the 500 range.
Yeah. Okay.
Unbelievable. I remember Chandler and Gilbert being about 600 at one point.
Yeah.
And that's you just step outside your front porch, go, I'm thinking of selling my house. Boom, you got 5 buyers. So,
yep.
But here's what happened to the Crawford Index. Look at that, just absolutely tanked. Because see, here it is right here, Pat. This is showing where we peaked on for all of them at 514. So with 100 being a balanced market, and right now we are at 102. I mean, we just fell off a cliff as soon as the rates went up. Just boom. We started actually going down before the rates went up, because the rates went up about what?
No, they started going up in Jan. They started going. No, they started inching up in really. I mean, honestly, God, it was like January 3rd. They started inching up. If you look at a chart, and I'll show you.
Yeah. So then it started slowing down here.
There's a delay. There's a delayed effect.
I wanted to look up the closings above list price just for giggles to see how much that's changed. And I looked at it and said, 15% of the contracts are going above their asking price, which I thought, well, gee, that's kind of odd. But I look and they're like $5,000, $5,000. And it struck me. I thought, I'll bet what's happening is people are saying, okay, I'll give you $10,000 over your asking price if you'll kick in $10,000 towards closing costs so I can help buy down my rate. Good evening. And even though this says 5,000 on an average, I said, well, and you and I talked about this today, and you said, well, don't you have the data for contributions? And there they are. We are sitting at 19% of all transactions now have some type of seller concession.
When was the low? What's that chart say? What's that low there?
See, like the low back here is 2% in July of 2021.
Yeah.
Nobody was giving seller concessions back then.
No. So that whole, if you look at the whole year, though, basically, I mean, they weren't.
Yeah, it was all under 5%, really. There was kind of an anomaly here before Christmas week.
Mhm.
And so, but the thing that I really wanted to stress with the home sellers right now is if you go back and look, I mean, if I just pull up my little sheet here, and you go back and look back here, well, it'd help if I showed it to you. The yellow line being homes going under contract and the blue lines being listings.
Mm-hmm.
So if you look at this yellow line right here, there's 3,974, there's 4,035, and there's 4,161. At this time back here, we only had available inventory of 8,000 homes.
Mm-hmm.
So you had 8,000 people that were listing their homes, and yet we had 4,000 homes every 7 days go under contract.
Mm-hmm.
So that meant that half the homes were disappearing and they were being replenished on a weekly basis. But
Mm-hmm.
that's why you had all the bidding wars. Well, now we have 20,000 homes on the market and only 2,200 homes going under contract. So if you're a seller, it's a lot harder for you now to get the attention of such a small number of buyers. And I see comments, what do I got to do? What kind of marketing do I have to do? It's all price. Buyers, you're clearly in the driver's seat on this one. So, and they know it. So they're out there, but they're shopping for bargains and they're waiting for bargains. And some sellers are making the good, bold moves and others aren't. I think you kind of have a little bit of a little bit of this at first, that's my price. And then there's a little bit of, I didn't think it'd be this bad.
Mm-hmm. Yeah.
Which I think is where we're at now, right? So
then you're like, oh crap.
Yeah.
I mean,
So
this is what the oh crap is about, right? Is that what you're trying to bring me on board here?
I am
This is my
bringing you on
segment?
board. I'm going to
This is
make
my
the chart bigger here, just the chart.
Okay.
So
Yeah, this is today we saw the bonds actually yesterday, after the CPI came out yesterday, we had just a horrendous. I mean, the opening was down 135 basis points, right at the almost right. I mean, it just came out and they threw the baby out. They threw a couple babies out with the bathwater. There was like a set of twins, I think they threw out. I mean, it was insane. I mean, but they're basically. But the thing of it is, we saw this capitulation kind of short term, but then it bounced back. It closed up. It was actually, it turned around and clawed back all the the losses. Obviously, there had some developments with UK, saying the selling was done over there with their bonds, but they, it almost felt like today is like the trader said, or yesterday, the trader said, okay, we think the worst is behind us in terms of inflation. And I mean, you saw, I mean, the CPI came out at what 0.4%. It was like double of what 0.2% of what it should have been. But Barry Habib has said that this inflation has been running hot, but the next couple months, comparing it from last year to this year, it's going to cool off. So, I mean, you saw, I said we saw this, this kind of this weird, crazy day yesterday. The volatility has just been insane. I mean, today, bond market was down 33 basis. The 5.5-year coupon was down 33. The treasury was up 7, to 4.02. But once again, you're just seeing this time frame where the dust they're trying to settle, and it's definitely, Barry does believe that the kind of the worst short term is behind us. So it's
Well, that's going to remain to be seen, because I saw a survey today where they felt that inflation was going to be with us for the rest of the year,
Yeah.
next year.
Oh,
And
it's gonna be, but from a short term standpoint, it's gonna be. I mean, you're talking in terms of just overall, but Barry is talking about the short term trading in bonds as far as comparing, last
okay,
September,
yeah.
the short term. Yeah, he's saying it's going to be a while before it gets out of there. But he said he's just basically looking at the technicals from a bond standpoint that, he said we're going to see some little bit of relief in rates here, hopefully the next couple months, come back down a little bit. But I mean, the bottom line is the real story is obviously inflation is here. It's insanely here, and they were talking about. I was reading something about the freight rates. The cost to deliver, rose like 1% in September, and it was like over 16% year over year. But they feel like some of these supply chains are kind of loosening up a little bit. But if a supply to deliver cost is up 16%, once again, it doesn't take a rocket scientist to figure that they're going to pass that along to the consumer.
Yeah, absolutely. And we have a question here I want to address. Why are prices not coming down quickly? Well, really, nobody has to sell right now. I mean, the people that are listing right now are listing because, maybe they're downsizing, or they're moving, or they're getting a divorce or whatever. But there isn't this mad rush to panic and sell because of the high percentage of people that are sitting on a low interest rate. They don't need to sell. So until that number starts, even as I was watching Altos this morning, and Altos Research, and what he said, he goes, look, let's say we get this really bad recession next year. And he goes, so you'll have a recession, it'll come along like the first quarter, and then you lose your job. Then you spend 2 or 3 months trying to find another one. And then if you don't, you can't make your mortgage payment. And then you finally start having that conversation with the bank about 90 days in. So he's saying it's almost a full year before you feel effect of high unemployment, before the homes start showing up on the market. So, that's going to take some time. Do we think there's going to be another bull real estate market? There's a lot of people waiting in the wings that could do that, but I sure don't want to see us repeat what we did before. And
no, I think I'm just kind of getting a sense that this is just kind of me reading and talking to people. Like you said, you and I try to throw out what we see. Going back to that, as far as prices coming down quickly, you and I have been, you and I have been talking about this for the last year and a half. I said I started talking about this, interest rate lockdown over a year and a half ago.
Yeah.
Saying there's so many people there at 3, last year I started talking about they're, at 3.5%. They're not going anywhere. And it's once again, that's why, these people that say there's gonna be a crash, I think you're starting to see the same type of time frame. Remember when in COVID, when COVID started, we thought, oh my God, we're going to see what's going to happen. What's going to happen? We're probably going to see all these foreclosures, and as it kind of progressed through the year, you're like, shit, these aren't really coming to fruition. And I think people that are saying that we're going to see a crash, once again, as we muddle along here, I think it's going to be evident that we're not going to see a crash, but we're going to see prices cool off. And I think everybody bought the stock at 10. It went to 25. Now it's sitting at 18 or 19. But they're still in the, they still got money. They still got up in the stock, so to speak, relative terms.
Well, Tyler wants to know what your guess is for a November hike.
I'm hearing, I think they're going to, I guess my guess is as good as anybody else's out there, because Paul doesn't know what the hell he's doing. So, I think, obviously I think there's like a 95% chance, or 95% of people out there, there's a, say that they're going to see a 75 bip move. I think they will. Based on the numbers running hot, because right now the Fed, honestly, they've been doing it really all wrong. They've been looking in the rearview mirror for the last couple of years. They look at the Fed number, the employment numbers, and they look at they're not looking ahead at all. So they're going to be looking at the inflation numbers, and I think they're still going to run it hot at 75 bips. And then, you get November and you get the December meeting, maybe they do one more 75. I think that's what the market's pricing in. And, do they do, now after November, it's going to be like, do they do 50 or 75? I'm seeing chances that they might do 50, 75 and then 50 in December. Start
Well,
doing
they asked, what are we telling our clients when they ask if it's a good time to buy? It depends on the price point and depends how long you're going to stay there. There are starting to be some bargains out there, not tremendous ones.
Yeah.
I think it's, will you buy and see a decrease in your equity? Odds are yes, but you've also you can pretty much find that house that you want right now. It's a lot easier to shop now. I had somebody going back and looking at my listing today for the third time so she can think about it over the weekend. When was the last time you got to do that?
Yeah. People call me and ask me, I tell them as a mortgage broker, I say, obviously what I'm seeing right now is people that just want to do it. There are some people out there like, regardless of what's going on, I'm going to buy.
Yeah, they want a home. And
they want a home. Yeah, they want a home. So they're not, but I'll tell you, I if people might, excuse me, I'm still getting all their cold. People tell me, I still think you and I agree that we still got some softness in this market. We still got some pullback, but I think my gut is that there's still, like you said, we still got a flush group of people out there that really do want to buy, but they have just said, I'm going to hold off now because prices are coming down. Rates are at 7.25%. If rates do come back down, beginning of next quarter or going in the second quarter, middle of the year, I think you will have another surge. And I hope I don't see it, but I think.
Well, Alto said that, the data's already shown that if you get down to 5.5%, the activity returns. And Rolo here says buyers are fine, sellers are fine, just people in the business freaking out. Are you freaking out, Pat?
No, I remember last week. I'm not.
It is what it is.
It is.
Numbers show you
what's
going on. So,
I apologize for getting on my soapbox last week because I was pretty ticked. I was just frustrated because, not because business has slowed down. I'm still working on deals. I've still got deals, but I'm just frustrated with the stupidity. Like last week, I know I went on my tirade for a couple minutes, but my tirade and my frustration were the fact that the feds are just, these guys are supposed to be the most highly intelligent people on the Fed. They run our world's economy, and they're just stupid. They don't know really what the hell they're doing, and they're whipsawing this market going from 3.25 up to 7.25, 7.5 on interest rates. Had it been up, 3.5, and then stay there a little while, then you got a little blip upward to 3.75, 4. Here, and then you got that for a while, and then we're gonna go over 4.25. But Jesus, when 6 months went from 3.25 to 7.25. And that's what's frustrating the hell out of me.
Yeah, they could have stair-stepped that up a little slower. Keto's saying, what criteria would you use to buy a house with intent to rent it out? Well, all depends on your cash flow. And then you have to pay very close attention to the vacancy rate, which is climbing, but slowly. So in Arizona, you need to look at our unemployment rate, our job growth, and the vacancy rate in single family homes. And then you also have to remember that there's the possibility that if tourism lags, like if we get a pretty good recession, that there will be a dump of Airbnbs because that's out there. They'll turn those into long-term rentals, or they're trying to sell them. So a lot of numbers to watch. But it still all boils down to cash flow. Now, if you're buying that home and it works on paper now for today's numbers, then just look forward and do some forward thinking and go, okay, now what if I have to go down $300-400 a month in my lease? What does that look for me? And just kind of pencil it out, because I was talking to an investor the other day and I said, what's your outlook? He goes, well, we're just trying to mitigate risk. We want to get a good deal on a home, but have enough margin in there to where if we have to pull back, we can. they want to buy something for $190,000 and sell it, for $290. What if they can't sell it for $290? So they, after they spend, $75 fixing it up, is it wise to get an appraisal on a cash purchase of property to secure negotiation leverage? Well, that's your call. I've seen people do that.
Can't hurt.
Yeah,
It's
it doesn't hurt.
$4 or
I mean,
5.
if you got an appraisal and go,
I mean, appraisal's $500. I mean, if you're buying a $400,000, $500,000, $600,000 property, it'd be like buying a $400,000, $500,000, $600,000 car and not knowing what kind of the value really is.
Yeah, there isn't a Kelly Blue Book for homes.
No.
I saw this today, Pat. I think you'd find it interesting. An article about how mortgage companies are laying people off, right? But there's a new term here that Rocket Mortgage and Amrock offered 8% of its team members ready for the chance to voluntarily accept a career transition incentives. They don't even call it layoffs anymore. Career transition incentive. They used to call it downsizing. Then last year they started calling it right sizing.
Yeah. Jesus, that's right,
So it's always fun to watch how they change.
Well,
Other big news happening. If you're into commercial real estate, pay attention to this one. Kroger, who owns Fry's, and they own Harris Teeter out in the East Coast. They own Fred Meyer. They own Dillon's, and they are put a proposal together. They're buying Albertsons, which owns Safeway and Vons.
Yeah.
And that's going to make them pretty darn big, but they're still only going to be like 13% of the total national grocery share, 13 to 15%. But they're doing this because Amazon's getting a larger share of food, and Walmart is still really kicking butt when it comes to groceries. But in this market, and if you're a commercial real estate guy, the Federal Trade Commission is going to be all over this, especially in our market. Yeah. There's a lot of Fry's, tons of Safeway, and a moderate number of Albertsons. So you can bet that while they try to consolidate their operations to save cost, that they're going to close some of those slow Albertson stores. I can.
So what the hell does this have to do with real estate, though?
Well, if you're, I know. Yeah, probably get beat up. But for commercial real estate people out there, there's some big boxes that are about to be emptied.
True.
I was
just busting your chops a little bit.
Oh,
there.
I know. Yeah.
Okay, we go from real estate to groceries. Let's bring it back in, Rick. Okay.
Yeah. Okay.
No, I agree with you there.
That's going to be an interesting one to watch, though, because you've got. I mean, I can think of one not too far from me that they're just going to shutter that one. Now you got this big anchor store there, and everything else is like, what about me? That's the problem, when they do that. And these commercial real estate guys, I've seen some pretty good transitions for stores that have closed before. They turn them into something else, like a bounce house, trampoline place. What's the high end market? Is it moving or is it stalled? Well, we just looked at the Cromford Market Index here, and it's showing that it's starting to turn in away from a seller's market to buyer's market. So, they're still got a Cromford Index of 159 and 157, 132 respectfully, and with 100 being normal. So it's still advantage for sellers, but it's eroding day by day. Fed not stupid, easy to play armchair economist. Buffett said inflation swindles almost everybody. Well, we still like to call them stupid.
Yeah.
Only because we can.
I don't think, they haven't really proven anything to me that they're really been, that's why we're seeing this type of volatilities, because they've gotten this stuff wrong. I mean, they're not stupid. I mean, I don't think they're just a bunch of academics that, like you said, are looking to me. I mean, they're not looking at sometimes they're looking in the rearview mirror. And, I will refute that, because like you said, had they've been doing their job, we wouldn't have had to have the 3/4 point hikes. They would have been able to, their job is to keep stable prices and stable employment. And they're not, obviously employment has been, with COVID has been obviously changed the whole dynamics there. But in terms of prices, in terms of, slash interest rates, they have not kept that stable at all. It's been a very volatile market. And I say shame on them for doing that,
Well, and you
So
pointed out the other day that Barry Habib was sharing one of the Fed chairman's comments
yeah,
on what they said about inflation and what they're saying now.
that's what I mean. And it's almost like they're playing. You got Yellen. You had Biden. Everybody saying temporary. Once again, a year and a half ago, that inflation was temporary, like it was just going to be, just a weather front that went through for a couple of weeks and then went through. I mean, it's not. It's here to stay for a while. So
Got the comment here on what I think apartment rates are going to do. It depends. I know in Chandler Gilbert and Mesa, there's all kinds of new construction going on. So we'll have to wait and see how much of an impact that has on vacancy rates. They could easily be filled because we're still growing. And Russ's worst thing they did was fail to refinance U.S. debt when interest rates are low. Yeah, I don't know how we get out. I've said for a long time that the debt bomb has been lit. I just don't know how long the fuse is.
Yeah, exactly. No, it's just I just like I said, I just think that they could have, there's just so much volatility in this market that it's caused a lot of chaos. I mean, there's one comment about them bringing the rates down for, it was kind of criminal what they did for the last couple of years. I mean, just, bringing rates down so low. I mean, they did. I mean, obviously we had the COVID, but, I think they could have put the brakes on it some time ago, but now they're trying to, they're about 5 miles behind the race and they're trying to catch up. That's the bottom line. So.
Just got how many months inventory do we have? I can do days inventory here and show you. We're sitting at 76 days, but let me get everything else out of there and just concentrate on single family residents. And we are slightly higher at 80 days. 80 days of inventory. That's pretty.
Almost
that's pretty
3 months.
hefty. Yeah. So, although I hate to use the word normal anymore, but normal used to be 4 to 6 months, and even using our current inventory, which is 20,700, that's relatively high, considerably high, considering the volume, because the volume is so low that even if you're only adding 3,000 homes a week, you're only getting rid of 2,200 of them. So that just means another 800 are sitting on the market. And that's what's getting us nationally, except for areas like Nashville or some other cities in the Midwest. They're not getting that inventory build like we are.
Mm-hmm.
We'd like the federal government to get out of a lot of things, but then when they do, we go, hey, could you come back in and help us?
But I mean, they should have been. They came in with Fannie Mae and Freddie Mac years ago, and they make a ton of money on Fannie Mae and Freddie Mac. I mean, if you look at the numbers of Fannie Mae and Freddie Mac, they're every quarter they're making a ton of money, making a ton of money. So I wish I kind of thought about that, Matt. I was like, make it. My thought was really simple. It's like, you know what? The federal government should get out just entirely out of the MBS market and let that be privatized and let the markets take care of itself.
Well, there was a HUD guy, Jack Kemp. I think he was he under Reagan or was it Bush? I think. And he once said, his famous quote was, if it wasn't for the government in housing, you wouldn't need the government in housing. And what he illustrated was how much everything got taxed from the time the tree got down to the time the house sold. That if you just start eliminating all these steps where the government gets in to tax this and regulate that, he goes, we've made houses so expensive because of that. Now we have to come in and subsidize people so they can have a place to live.
Yeah.
So I thought that was a very interesting quote. But I think, going forward, it looks, here's what I see. Just going into November.
Give us your. I think that's. I mean,
I will be in my travel trailer taking a nap. So
yeah, I mean, where's this? All that we're talking about. Where's this leave everybody? So go ahead.
Yeah, well, we do have one here. It says everyone, sellers and buyers, are frustrated with you, Pat. What happened in the last 2.5 years is they're criminal in the housing market. I think you touched on that, it's not, I don't want to say criminal, but here's where I see the next couple months. It's just going to be stagnant. If you got a listing out there, you're going to be begging for help, and buyers are going to wait. Holidays are coming, going to be traveling, Christmas coming up, but the serious buyers,
we're a stalemate.
Serious buyers are going to have opportunities in November and December, and the opportunities, sellers don't determine the price. Buyers determine the price. The market determines the price. I can ask $600,000 for my place, and if all the buyers don't think it's worth that, I won't get the $600,000. So how well did I do setting the price? Now, we are seeing still 1,500 open door homes out there. 1 out of every 6 homes right now is being sold by open door, and they keep deep discounting, and they're starting to affect appraisals in some neighborhoods. That may accelerate in December as they try to offload things for the last quarter. That's one of the unknowns, but as a buyer, that's kind of where your eyes should be. Your eyes should be looking at those guys, because they want to get rid of them. Some of the listings that are out there, they're just putting them out there to see what happens. But there's going to be more and more people sitting on their hands. We're going to be a part of the creditors committee, and as in bankruptcy, we should be in first position. Open Door is still buying homes, but they're not buying them as aggressively. So they are still purchasing, just like that investor that says we're a lot more careful what we're paying. And so you can see that Open Door is going to increase their fees. They're going to try and really push convenience for you. Look, I know it's a tough market, but we can cash you out. Sure, it's not going to be the highest price that you thought you could get, and we're going to charge you, 6% fee, service fee, not commission, but they'll get you up underneath the house. Now they got some margin and wiggle room, go in and fix it up a little bit, put it back on the market. But that doesn't mean they're going to make money.
Kind of like the Inflation Reduction Act, kind of play on words, huh?
Yeah. They're going to lose less.
But
so
I agree with you. I think we're going to see is what I'm kind of getting and feeling out there, just so you get a sense of, the energy out there, is that we're kind of stalemate. We're going to plod along here. I don't see rates. I mean, rates are, I'm getting still high 6s in a lot of lenders are out there at 7.5, and I can still pull, high 6s, 7. I don't see, my gut feeling is that the market's kind of pricing in, like Barry has said, that he feels that the market looking forward, because the market's always looking forward 6 months, that they feel that's why you saw that capitulation, I think, yesterday, short term, that the market's looking ahead the next 6 months, say, hey, maybe we are behind, the worst we've seen. But I think we're going to, if I was a buyer, and I just have to correct a couple of things. One thing that I said a couple months ago was, I was kind of poo-pooing that 2-1 buy down, and I have to correct myself. And basically, Terry, don't call me. I won't.
Terry's business. So.
Maybe, I guess Terry doesn't like me anymore. But
clear that up, Terry.
What's that?
Clear that up, Terry. 2-1 buy down. You didn't think that was a good idea?
No, I didn't think that was a good idea, but I think it is actually. I started looking into it, and it really is. I mean, with the market softening, you can get, sellers can get you $10,000 to $11,000. It's going to be a difference of about, $300, $400, $500. The first $300 to $500 on the first year, and I'm going to give you a reason why. At first I thought it was gimmicky, because I just hate this gimmicky crap that people, lenders come out with. It's just, I don't know, it just drives me nuts. But it made more sense to me as you see the rate, the environment that we're in. Okay, rates are going to peak up here. You get somebody to kind of buy your rate down for a year or two, so look, you start at 6, so you lock in at 6%. You start at 4 initially for 1 year, goes up to 5%, and then 6% years after. So in the third year, you'll be at 6%. Hopefully, the next 2 years, you're going to have a chance where rates come back down, where you're going to be able to refinance that and get in a 3.5% or 4% range permanently. And any monies that are not used in that 2-1 buy down goes to, it's an escrow account, so it basically goes to pay off your principal, pay down your principal. So it's actually not
and it makes sense if you get the seller to contribute to that.
Yeah. Well, the seller has to. I mean, there's some lenders that have that you primarily the seller has to contribute. There's a few lenders that go outside the box. I don't know how or why they do it, but primarily 98% of the lenders I see out there, the seller has to contribute. So it does make a lot of sense versus just dropping 10 or 15,000 to contribute. That's probably why we're seeing the seller concession stay at 5,000 more, because the 2-1 buy down really, it does make a lot more sense. And I was dumb a couple months ago to say, I was poo-pooing it, but I was wrong. So,
well, were you as wrong as the Fed?
No, I don't think so. Yeah.
How much higher do you think rates will go? Everybody's rolling the dice on that one, Jaker.
I personally, it's a throw the dart, but boy, I tell you, I mean, we start to see you're starting to see the effect of 6.5 or 7% in the housing market. Let's project if rates were 7.5, 8 to 8.5. I mean, how much more slower do they want to, slow the market? So I think we're seeing kind of a tipping point because, like I said, Barry Habib says he feels we're behind. The worst has been behind us with inflation for short term. We're going to still have inflation the next year and a half, couple of years. It's going to take a while, but it's going to I think you see some, people, pretty smart people talk about the fact that it's going to moderate maybe into the 4.5, 5 range, come back down.
Well, they've definitely put the hit on housing, and now you have to wait it out. I think it's pretty obvious that when you got above 6.5, that housing cooled, slowed. It hasn't sprung back. We don't have more buyers, so they could hang right there, and prices will start to come down gradually. But there's just way too many. Housing isn't the only thing that the central bank looks at when it comes to rates. There could be a huge liquidity crisis, and they're going to go, to heck with housing. We got to get back to quantitative easing. So, and England illustrated that last week with the pension market.
Yeah.
Powell said paying 8-9% would cause that. Yeah, I think you're right, Tyler. But he's also talking about unemployment pain.
Yeah, no, that's right. He's talking about unemployment pain. Yeah.
You've got to pull back the amount of money in circulation in order to get inflation down, and it can take a couple of years. This isn't going to happen by 4th of July.
No.
And looking forward, we've still got fuel and we still got food that are an issue that the central bank can't do a darn thing about that. And that's the big challenge.
Yeah. No, I mean, Matthew said that's a foggy crystal ball for the rates. I know. But I mean, yeah, first of all, I mean, nobody got crystal ball. Nobody thought, huh?
You said we're going to be down in New Albertson stocking shelves. I go, yeah. I used to do
that. Nobody had crystal ball that they're going to go down to 2.5% 2 years ago. And nobody thought that they're going to go from, I guarantee you, if you ask somebody in January, February, rates sitting at 3.25, that we're going to see 7% by, September, October, they thought you would have been smoking crack. I guarantee you.
Well, what about the talk that Matthew says here is that, do we have to have rates higher than the rate of inflation?
No, you know what? I think that's just, I don't, I mean, my personal, I mean, this is let's take this with 1 cent. I mean, why, do we really have to? Just get inflation out of, I think this inflation has all been caused. It's been all energy-based causation. So.
Yeah. There's so many moving parts in this, and Terry's right. I get the bread aisle. So the feds have to stop spending. We need budgets and no more CRs. Feelers today need them to start QE to lubricate the bond market. Yeah, there's a lot of chatter going on out there, but I'm not going to get political because I'm not going to do it.
You're going to get yelled at.
I'm hurt.
I think once again, you try to predict time frames. I think like you've heard me say this about a million times now. I'm trying to segment the market into in the time periods, and I mean versus one week or 2 week. What's going to happen next month or 2 months from now? I think to me mentally it makes a lot more sense in my mind. Looking at 8 years, 2018, 2019 as a period, and then 19 to 21 was this crazy ass period. Now now we're in, the end of 21, we had, craziness. Beginning of 22 is when we really started, you showed that one chart where housing we saw it increase at a decreasing rate. It was increasing, but it was decreasing really. So it started beginning this year. So we're already been in this thing for the last 10 months. And maybe we're in this thing another, my take is I'm just trying to segment in periods of time, because I think we got another 6 to 8 months of craziness, but I think it'll settle out. But it's going to take a couple of years for this inflation. No doubt about that.
Yeah. So. And that's the next, Tyler, that'll be included in the t-shirt collection that we're going to be coming out with. Pat analogies.
Yeah.
Well, I want to thank everybody for participating. Pat and I talk a lot about how much fun we have on these Friday shows, and I didn't endorse anybody last time, Michael. But we really.
I will say though, I think Carrie Lake is pretty hot.
Now I got to cut you from the channel. But we really like the back and forth and the interaction with everybody when they get on here. We do somewhere we just record things, but we don't get to, we get to see.
I enjoy the people coming in, comments, and whether, Tyler, I wish I could be an Irish, the F-bombs were going to come last week, if anything. I've kind of calmed down a little bit, but no, I think, we're just trying to make sense. I mean, once again, like I said, I really think I'm just this, because I'll leave, this is me going off on not tirade, but you always try to figure out what's going to happen, today, tomorrow, next week, or 2 weeks from now. And I'm like, this kind of drives you nuts. So that's why I'm trying to stretch out my time frame segments on the economy and say, okay, we went through this period. Now we're going through this period. Like kind of like Barry Habib said, and he said it a couple weeks ago, he goes, this is just a bridge we have to cross right now. And that's where you have to kind of look at it.
Yeah, you're gonna have to put a 6-month watch on everything that you're doing right now. So yeah. But well, again, I appreciate everybody watching, the millions and millions of viewers. This is better than when I actually did a stint in radio, because in radio, you're spinning records and you tell a joke. You don't hear if anybody laughed or not. You think it's funny. You just tell the best joke in the world, and you're just in this little room going, I wonder if anybody got that.
Well, as I always say, I've never met a mirror that I didn't fall in love with.
Yeah. So, how's the therapy going?
Well,
anyway, everybody have a great week. I'm heading back out to Lost Dutchman State Park. I took my travel trailer out there. I just love it. I like looking at the views out there, and I took my mountain bike off the back of the trailer this morning, and the front tire was low. So I got my pump and I started pumping it, and it ain't going nowhere. So I'm going to go now and pick it up from the bike shop. So hopefully with a tire full of airs and all right. Guys. Thank you, everybody. Pat, have a super weekend. Have a chance to come out to Dutchman. So
yep, I will. All right, buddy.
Okay. See you.
Have a good weekend. Bye-bye.